I definitely came to the realization that we were really in a very significant situation. Actually, I was in China at the time at a World Economic Forum event as all of the news was starting to unfold and really starting to accelerate. And it was an incredible chain of events that was occurring over that period of time. And certainly lots of sleepless nights as you were trying to understand the news. Sleepless nights for me because I was in China as I was trying to understand the news and how it was impacting the markets.
When it comes to lessons learned since, there's a lot of talk about risk and how boards need to react. But what has really changed for investors since then, and how does it affect the way you approach Nasdaq now as CEO?
Well, I do think that it really created a situation where we had to look across all of the asset classes that were trading at the time and say, well, where are there exposures where individual investors could be exposed and involved in those markets? And I think that the regulators have done a very good job of realizing that what the ecosystem that's been created around the equities markets and the robustness of the equities markets and the risk management that we have in the equities markets with centralized clearing, the transparency we have, really ought to be applied more and more into other asset classes. And they definitely focus on fixed income clearly as the next area of focus for more transparency, more central clearing, and more rules and regulations to create fairness in those markets.
As we go further into the era of financial technology, fintech, cryptocurrencies, how much has that mindset that you just talked about, born out of the financial crisis 10 years ago, do you think influenced the way regulators and leaders like yourself look at some of those intersections between technology and finance?
Yeah, it's a great question because I think technology is a great enabler in the financial services industry. And in many ways, technology can, in fact, create fairness. I mean, you can look at the dawn of the internet and online trading and the ability for really democratizing markets for individual investors. However, at the same time, you have to make sure that those technologies are applied in a way that does create fair and orderly markets, that does improve the integrity of the markets. And so I do think that regulators and exchanges have a role to play in making sure that new technologies are used to improve fairness and to improve transparency and market integrity, and not used to create winners and losers. So that's one of the things that we're very focused on here at Nasdaq with technology.
You know, I was based out in Silicon Valley when the financial crisis hit. I was also out here during the dot-com bust. And I got to say, from a technology in Silicon Valley perspective, it really feels like the dot-com bust was the major event, and the financial crisis was kind of secondary. I think it's flipped if you're on the East Coast, certainly if you're in the business of markets and banking. How do you compare the two as far as their legacy, both in financial markets and then when it comes to technology and innovation?
Well, in fact, I was at Nasdaq during that entire period of time, too. So I can say that really the dot-com situation and some of the other, there have been certainly events during history that have really impacted the equities markets, and certainly the internet dot-com bust or bubble and bust really was one of those seminal events in the equities markets and created a lot of change. It created change in governance. It created change in market structure. I mean, it changed really a lot of the ecosystem in terms of making sure that investors are fully informed of risk, that we have fair and resilient markets to support them, and that we're mutualizing risk across the ecosystem. What happened in the credit crisis really was a lot of those same learnings and lessons came into the fixed income world. So what we had done to develop the equities markets really is now being implemented, you know, in various degrees across the fixed income spectrum.
All right. Adena, I wonder, as you look at the situation now and how you and companies are preparing to deal with the next crisis, and there will be one, we just don't know exactly what its nature is going to be, how has the preparation shifted since these past two shock events we were just talking about?
I do think that the entire financial services industry is much more focused on risk management than it ever has been. And I do think that coming out of some of the shocks in the equities markets, you saw a risk management protocol and infrastructure and architecture that was created to help support and make sure that we are much more protected, and that individual investors, most notably, are more protected and more informed. I think that what we're seeing now is the regulation that's come on the back of the credit crisis has really created a much more resilient banking system and a much more resilient market system for fixed income. Now, so that risk management mentality, I think, has been much more integrated into the culture of the financial services industry. I also agree with you that there are always going to be areas where kind of opportunity could run away from itself. But at the same time, I do think that there are a lot more controls at the banking level, at the broker level, and at the exchange level to help protect investors in those situations.